How are you, Linda?
Good. You don't have video, Matt. Hey, Phoenix.
It's coming here. There we go.
There we go. Hey, Alan.
Hey guys, how's it going?
Doing well, doing well.
I'm just really excited that this link worked.
I was worried for a minute. I was like, what if we all have the wrong link? Well, we'll give everyone a couple minutes. Matt, as you know, in real estate, everyone tends to run between 10 and 30 minutes behind. So we'll give them, we're still 2 minutes before 11, so we'll give them a few minutes.
Absolutely.
I need you to please stop coming in my office.
Mom, I want to join me.
I will come draw with you after. Give me a second, guys.
Someone's going on mute. So Matt, how do you know Linda?
So I worked with Linda. I've known her for maybe 4 or 5 years now. I met her through a mutual friend, and yeah, so she's been great, great to work with. How long have you been in the real estate industry?
So I bought my first 2 rentals in 2016 and then became a full-time realtor in July of 2017. A little over 3 years.
Good for you. Good for you.
Yeah.
What was your past life?
I was in technology for about 15 years. So I started out as a software developer, and then because I know how to talk to people, I became management very quickly. Software developers aren't known for their ability to communicate.
That knows how to talk to people. That's quite the skill set there.
Yeah, I speak geek and business.
Yeah. Diamond in the rough.
How about you? How long have you been doing what you do?
I've been in this industry for a little over a decade now. And so,
Nice.
Yeah, I got started off kind of the whole traditional financial, planning, working for the big firm. And it was just, I hated every minute of it. And,
I bet.
Nearly left the industry, and it then just kind of started to blaze my own trail from there.
Nice.
So, settle in and doing what I love to do. But yeah, no, that's exciting. It sounds like you have a good group here that kind of gets together on and your focus is more real estate investing. Is it for each agent kind of individually, or is it also kind of using these tools to help clients?
I think it's both. The focus of our wealth building education really is around how, as realtors, do we build our long-term wealth, since there's no 401k for realtors. So there's a lot of agents that don't yet invest, but I think as they learn how to invest, they're going to be able to teach their investors how to invest, right? It kind of all ties together. Absolutely.
And it's going to allow them to close more deals as well, right? Because they're going to be able to
exactly
to help them on the education side to understand.
Sure. Yeah. Hey, Jen, welcome.
Hi.
How are you, Jen?
Great. How's it going?
It's going well, really well.
Good. I'm here to learn how to get rich.
Yeah. Well, I'm looking forward to this. I'm glad you're on the call.
Yeah, thanks. I'm going to mute myself. I've got a lot of background noise going.
Okay.
Sam, welcome to the call. Glad you could join us.
Sam's an advisor that works with me here, so he's joining the call for training purposes.
Wonderful.
Great to be here.
We'll probably give everyone like 1 more minute. I know there were a couple of people in our meeting yesterday who had said that they were interested in joining, and I don't see them here yet, so we'll give everyone just a couple more minutes.
Alan, are you able to allow me to share my screen?
I sure am. Let me do that. Okay, you should be able to now. You might want to test that just to make sure. Hey, Paul, welcome. There you go. Perfect.
Yeah.
While we're waiting, Matt, would you prefer that people ask questions as we move through the presentation, or would you prefer to hold those questions until the end?
Yeah, I generally prefer to either write it into the chat or write it down
Okay.
so that you don't forget, but then we'll
Great.
address them at the end. That way,
Okay.
you know, we can just kind of cover all the questions and go back to where we need to.
Yeah, that sounds great. So everybody just feel free to pop your questions into the chat box, and then Linda or I will ask those questions at the end.
All right, you just let me know once you're ready.
Okay, so we'll start off by first of all introducing you, Matt. So this is Matt Romney, you guys. He is an investment advisor, and I've been working with Matt for the last, gosh, has it been 3 years, Matt? It's been a while.
It has.
And he's really been quite instrumental in helping me to not only structure my wealth, but to save money on taxes as well, which has been great. Who's got that background noise?
Oh, I think it's me. Let me.
You're good. So, so I asked Matt to come and speak with us today about investment strategy, specifically around real estate, and discussing a few of the things that he would recommend employing in your businesses and your lives as you start to invest more heavily in real estate and think about your retirement and your future. So without further ado, Matt, take it away.
Thank you, Linda. Very kind of you to say all that. But the biggest compliment I can get is that I'm helping people save money in taxes. That's my passion. That's probably what I take pride in the most, is my ability for proactive tax planning. So like Linda said, I am an investment advisor. My certification is called the Certified Investment Management Analyst. It's one of the few globally recognized investment management certifications. And when I got that, the skill set that I learned there was, it's not just within the capital markets of stocks and bonds, but I also learned the math behind all types of investments, whether it be stocks and bonds or real estate or private business. Okay, and so that I use that knowledge and that skill set, bring it to my clients to help them to make better decisions. I'm not here to sell myself. I'm here to educate you and just kind of hope to paint a different perspective of how real estate investing works. I will say though that I'm unlike any advisor you're going to come across, or at least 99.9% of them, in that I genuinely love my clients to be invested in real estate, and I encourage it, so long as they're willing to do what it takes to get the returns that are out there. So, which is exactly what we're going to be talking about today. All right, so within this, presentation, we're going to be talking, and by the way, as we're going through, if you didn't hear, if you have questions, please either write them down, enter them into the chat, or make note of them. At the end of the presentation, I will gladly answer any and all questions that you have. Okay. First thing we're going to discuss is using data to make better investment decisions. We're going to then cover where investment returns come from in general, moving on to understanding real estate investment returns, as well as tax efficient investing, and then bringing it all together and synergizing all the pieces of your wealth to get better returns and accomplish your goals faster and more efficiently. All right, so first and foremost, I work with a lot of real estate professionals and a lot of real estate investors. That's probably my top clientele that I deal with. I guess, it's more of just that I'm against the grain of your typical financial advisor and just trying to get them to save money in a retirement account. That's not my style. If your best investment first and foremost is going to be your business, right? Beyond that, real estate may very well be your second best investment. And so with that being the case, everything else we do financially comes in and fills a supporting role to that. it's important that the other pieces of the puzzle never get in the way of your top two investments. Instead, they're there to fill that supporting role. And in all the years that I've worked with real estate professionals and real estate investors, I always ask them, what kind of returns are you getting on your property? Do you know the return you're getting on each property and what you expect them to do going forward? And honestly, I would say probably 9 out of 10 times, the answer to that is no. And I always kind of take a step back and I think, it's amazing to me because any business will tell you the importance of using data to make decisions. Yet for so many real estate investors, they're making their decisions blindly. And in many cases, that can cause them to actually make decisions that go against really where they want to go in life. And so that's the fundamental importance of it. And so when it comes to using data, and there's a lot of different metrics to use. The initial hurdle when you're looking at buying a property, and you all know this, right? There's more heuristics or rules of thumb to use and calculations. But the very first step is going to be cap rate, right? You're going to look at the cap rate, and then that's going to give you kind of an initial screener, and then you may dig in a little deeper and go on cash return. From there, you might start to begin to analyze the property a little bit deeper by looking at internal rate of return, the IRR. And where I like to take it a step further is through analyzing the after-tax internal rate of return, especially on a property that we're doing some due diligence on. And the whole key of that after-tax standpoint is this is where we start to see the differentiating factors of a property and how it becomes unique to you and your tax circumstances with the strategy and the expectations there. Once the property is owned, and now we're looking at the data of how this property is performing, we're going to focus on those two last steps, right? We're going to be focusing on after-tax internal rate of return, and we're going to be focusing primarily on after-tax return on equity and return on assets. I would venture to say that the after-tax return on equity is the most important, okay, for the properties that you currently own. This is going to give you, in essence, your opportunity costs, your kind of what else you could do with the money type situation. And this is going to give you the real-time data of how you expect these properties to perform year in and year out. We're going to dig briefly into those numbers here in just a bit. But kind of moving on to the next phase of it, I want to talk about where returns come from. And just for a moment, I'm going to welcome you because I always love asking this question. And this is for investing in general, whether you're investing in a business, investing in real estate, whatever you're investing in. What are some of your thoughts of where returns come from? Does anybody have any ideas?
Cash flow from the property, from a rental.
Good, right? The profits or the income. Very good answer. Anything else, Jen?
I was just going to say the equity that's built and then the tax benefits.
Yeah, very good. Very good. So those two answers right there, not surprisingly, two most common answers that I hear. And the thing is about that is that's only about 50% of the equation. Obviously, the income that an investment produces or other benefits that an investment produces, obviously that's part of the return equation. However, I want to kind of show you really where the primary factor is when it comes to return. So let's say business XYZ, and let's say I own business XYZ and I make pens, okay? And I distribute $10,000 of profit every year from my business. So nice little small business. So the question being is, how much would you be willing to pay for that? Right. And so if you as the investor look at it and go, well, for 10 grand a year of profit, I might be willing to pay 100 grand for that investment. And that would represent, right, simple math, 10% return. But maybe your neighbor down the street, you know, they're looking at it and they're going, I don't know, right? Pens is kind of a dying business. Everybody's using computers and tablets these days. We're not using pens. That's a risky industry. Or Matt, I don't know about your management style. I don't know if you're that good of a business manager. I'm only willing to pay $80,000 for it, right? And so in other words, because of the risk factor, that second investor is requiring a higher rate of return, right? And so that, you know, we always have to remember the returns are largely dictated by the price that we're willing to pay for an investment, okay? The profit or the income and the tax benefits, while there's exceptions to this, they largely are what they are. And so what is going to be the moving, you know, the moving of the needle, if you will, is going to be how much we're willing to pay. And real estate's a great example of this. And you can see it really, you know, really clearly when you kind of look at real estate sales, you know, from a 30,000-foot view. But increased return from the properties you purchase, it comes from risk. And it can be from a variety of risk factors, right? I mean, low income housing, or, you know, maybe there's the risk of that property needing rehab work, and, you know, kind of a little bit of uncertainty in terms of what that's going to generate of increased income, so on and so forth, right? The thing that's unique, so this principle, by the way, is this, you know, increased returns come from risk, increased risk. This is a fundamental investment principle. It is true in every type of investing, whether you're talking about the capital markets of stocks and bonds, real estate, private business, everything. Increased returns come from increased risk. The thing that makes real estate investing unique is the bulk of the increased returns, or the bulk of the risk, I should say, that generates those increased returns comes from leverage. That is the power of real estate. That's what it has to offer, right? And so that is going to be the primary force that drives most of the increased returns that we know real estate can provide, okay? And so a fundamental part, well, kind of going backwards a little bit, I've mentioned that I deal with a lot of real estate investors, and most of the time when I'm kind of having a conversation or an initial conversation with a real estate investor, you know, I'll ask them, what are your goals? What are you trying to accomplish? And they're generally going to say to me, most of the time, right? I want to have 200,000 of passive income in X amount of years, or I want 100,000 or 50,000, whatever the number is, right? I want X amount of passive income. Or I want to buy, you know, X amount of doors per year, right? So those are probably the two most common that I come across. And, you know, those are really good goals to have, I want to paint a little bit of a picture about how our focus in real estate investing and how we view our goals, that can affect how well our wealth is building, okay? And so let's use the example of somebody who wants $200,000 of passive income, right? Usually when I hear that, I'll ask them, why? Why do you want 200,000 of passive income? Or what is that going to do for you, right? And the answer might be something, you know, it's going to give me the peace of mind. It's going to make it so I don't have to rely on selling, you know, year in and year out, and I can just work when I want to, whatever it may be, right? It's going to give them something emotionally, or maybe it's just going to allow them to cruise off into the sunset and retire. And I say, great. That is what we focus on. When it comes to our goals, we focus on the why and the what, not the how. Doesn't mean we don't look at the how and we don't analyze it. But if our primary focus is on the how, we then end up getting blinders, and it can actually cost us more money down the road. And a great example of that is ultimately with how real estate investing is taxed. You see, a lot of the real estate investors that come across my desk, they're making 150 or 250, 300, whatever the amount is that they're making in income. And their goal is to build up that passive income along the way. But far too often, it's not necessarily so that they can just retire. A lot of times it's so they have the ability to retire should they want to. But remember this about real estate income, the passive income that is generated from real estate, that's taxed at ordinary income rates, right? And so now all of a sudden, versus the capital gain rate. So take an example of somebody making $200,000 a year, and they're saving as much as they can, they're building up their real estate portfolio, and they're working towards generating $200,000 of passive income. So that's 400,000 total. And now, by the way that individual has structured their real estate portfolio and their strategy, they're getting taxed on the bulk of that growth of real estate. They're getting taxed at 40% marginal rates versus the 20% capital gain, right? And so it's important to remember, and that's why we focus on the what and the why instead of the how. Because if our goal is just for income, it can actually cause us to pay way too much, even double the taxes that we should. Imagine 40% taxes on 200,000 of passive income. That's 80 grand, right? That's 40,000 more than maybe you could be paying. And so instead, what we do is we shift our focus on it, and the way we structure our real estate and our ultimate strategy, and basically kind of the decisions we're making year in and year out with these properties, it affects our net after-tax income, right? And so we'll kind of get into that hopefully a little bit, should we have time, but I just want you to kind of see that picture a little bit and understand the different taxation side of things when it comes to this, because, and by the way, this is a mistake that stock and bond investors make as well in the capital markets, and I would say real estate investors that are investing on their own with stocks, they tend to make this mistake very, it's very common for them. They tend to go buy stocks that are high dividend paying, high income producing. And so the same principle is true in that side of the equation. When we focus our efforts on just the income, and that's our primary decision, it actually ends up, putting us in a situation where we have lower overall returns and we're paying higher taxes. So our net after tax return ends up being significantly lower, right? Same thing applies in real estate. All right. So I talked a little bit about the different metrics that we use when it comes to analyzing a property. So what I did is I went through an actual scenario. I just changed the numbers a little bit that I came across recently with a client on a recently purchased property. And so then this generated the data a little bit. So in this property, it was like a $400,000 property. It's about a 5% cap rate. The numbers aren't a big deal. What is a big deal is the trends and the line. I want you to understand how real estate investing and the returns that come with real estate investing, how this is shaped over time, okay? And so a lot of times, by the way, I recently did an analysis, a real estate analysis for a client who had owned their property for over 25 years. And they came to me, we did an analysis to see how this property is performing. And they were shocked to hear that their internal rate of return on an annualized basis of this property was about 5.1%. That's how much they had earned annually on this property on average. Right? And I said, really? The numbers don't lie. Right? That's what you're earning on this property. And so here's why. Right? So I'm going to illustrate to you how real estate returns work. You'll notice when we look at the early stage of the property, the return on equity is very, very high. But each and every year, as that property, as the value of the loan gets paid down, the return on equity naturally is going to decrease throughout the years. Starting, you know, obviously every property is different. In this scenario, starting at about 16%, going all the way down to just slightly above 4% after 30 years. You'll notice these huge kind of drop-offs are going to be a lot of times big shifts with the mortgage interest, you know, fully dropping off, as well as depreciation benefit dropping off, because these are after tax return, you know, calculations. And so then when we look on the next slide and we look at internal rate of return, we follow the same trend line, right? In the beginning years, and this is what I explained to that client that had a property that they earned 5.1% on, is in the beginning years of this property, they earned a very, very high return, right? And I've seen it all, right? Point being, early on, very, very high returns that real estate provides. However, as the equity builds up, the loan gets paid down, and the property appreciates, that return on equity, as we can see here in the yellow, as that starts to go down, it drives down the internal rate of return annually, okay? And so that's essentially the trend line of real estate and how it works. That's just the math and the data. If you buy a property, you gradually pay it off over 15, 20, 30 years, and you just gradually increase rents as normal, and we have kind of normal expected appreciation, you are going to expect a return on an annualized basis after, say, 30 years, somewhere between 5.5 and 6.25 is usually pretty much the average. That's the average annualized return. But what we notice, if we focus in on those first 5 to 7 years, the internal rate of return of that property is outstanding. You cannot beat it. So remember what we talked about earlier. Those increased returns come from leverage, right? So what do we learn from this? Well, we learn about the importance of continually analyzing our properties, understanding where that after-tax return on equity is on a year in and year out basis, so that when we start to see that return on equity dip and start to fall below whatever the threshold is for the individual investor, we now know it's time to make a move. We need to put that equity to work again, right? And so the beauty of real estate is we have multiple options with this. We can turn around and we could do the 1031 exchange, kicking the capital gain tax down the road. We can take a loan and extract the equity out of the property, taking that money, putting it to work. There's all sorts of things. But it is work, right? And this is the big thing that I try to educate my clients on is, you know, real estate absolutely can be an amazing path to build wealth. But it takes work, right? Imagine having 10, 15 properties, and now you're having to churn through those 15 properties every 5 to 7 years. So that's 2 properties a year that you're doing a 1031 exchange, or you're pulling equity out so that you can keep maximizing the return on equity, right? That's the name of the game though. That's how the wealth is built when it comes to real estate. The math doesn't really lie on that part. And so moving forward from this standpoint, we'll come back to it. I'm sure there's going to be some questions on this, but I love illustrating this so that we have the right expectations in terms of how we can get the good properties. You know, there's every now and then when I don't have the chance to go through the data with somebody, they'll push back a little bit and go, no, that can't be right. 5.1 or 5.5% return after 30 years. I've heard everything that real estate is the path to wealth. Well, I mean, think about it, right? It just isn't that easy. Nothing is. You know, if it were that easy where you just had to keep buying properties, pay them off and coast into the sunset, there would be a whole lot more people with a net worth of more than 20, $30 million, right? Instead, it takes actual work. It takes treating your real estate investments as a bona fide business, okay? All right, so when it comes to that tax efficiency side of things, it's incredibly important. Like I've mentioned before, we're focusing on that net after tax return. And in doing so, we're starting to align everything from an individual standpoint with your goals, your unique situation, and we're figuring out ways how to maximize this for you, right? And the beauty of it is, by the way, when you're through the income building years of the property, or excuse me, of your lifespan, and you're in the growth stage of building your wealth, by following those principles of keeping that equity working harder for you, you inherently increase the after-tax returns of the property as well, because you end up shifting your primary source of profit, if you will, on the properties from the passive income side to the capital gain side. So not only are you maximizing the return on equity with them, but you're also reducing the tax costs and the tax burden. So when we do this, though, you've got to understand that when your overall portfolio is humming like this, caution has to be taken, because it's really simple. How are we getting better returns? By increasing the risk, right? Just like what we talked about. And so now we're keeping these properties high, as highly leveraged as possible. So this makes it that much more important that we have surrounding strategies within our overall wealth to balance out that risk, right? The risk of increased leverage. And so in doing so, say real estate is your best investment. Obviously for each of you, it should be below your business, but for your rental properties being your second best investment, everything we do is, again, to fill a supporting role. So this really makes it important that we have proper short-term reserves. We're building some tax favored assets. We have other investments. We've got some good core savings, all of that. And all of this is designed to support what you're doing from the real estate side to help to mitigate the liquidity risk that comes by increasing your leverage. Right? In other words, we've got to make sure we have access to money. We've got to make sure we have liquidity going forward. And so that's how, as we're able to build the overall piece and make each part of your wealth work together, you're able to increase your returns and decrease your taxes. Okay. I don't want to take too much time on this, but for real estate and agents in particular, there are all sorts of opportunities. I brought up the tax favored assets side of the equation because a lot of times real estate investors, they get wary of retirement vehicles, because they don't want to just sit and chalk money away for retirement. That's not the point. And I fully agree. However, for some, these can be useful because they can actually be used and put to work now, not just in retirement. The only caveat I will throw out there, and we don't have time to get into it, but I'm always happy to if necessary, is generally speaking, I'm not a huge fan of the self-directed retirement accounts. And there's a lot of reasons why, but I'm just going to put it simply in that the tax bite ends up being really, really large down the road when we're investing into real estate within those. Real estate has wonderful, wonderful tax benefits that it provides us, and we lose a lot of those tax benefits by placing the real estate within the self-directed. So I just wanted to touch on that real quick, but that kind of sums up everything from my end. I'd like to turn the time over. So we have one question that was entered into the chat, And then I'll turn the time over to everybody to answer your other questions. So the one question being, how do you calculate internal rate of return? So internal rate of return is a cash flow calculation. And so there's ways that you can use, you know, your financial calculator that you had in high school and college. I use this every day. You can use that to calculate the internal rate of return of something, but you can also use Excel, right? Because in essence, what an internal rate of return calculation is doing is it's taking the present value of a series of cash flows and providing you with the return, right? And so that one's kind of a complex one to answer, but hopefully I did okay on it. What other questions?
Matt, at what point does it make sense? So I know for a lot of us, the concern is, say I have a property that it cash flows, but it doesn't cash flow a ton of money, right? Maybe only a couple $100 a month. At what point do you look at that property, and when you're looking at the internal rate of return, and decide that it's either time to pull equity out or 1031 it? Like, what are the indicators there? And if the answer is, I don't want to sell it, I want to pull cash out, how do you justify pulling cash out of a property when you already are working on such thin margins?
Yeah, so I'm so glad that you brought that up, Linda, because most real estate investors, this is probably the hardest thing for them to grasp, you know, when they're working with me, is they've been like mentally and emotionally, by the way, like a huge part of my training is within behavioral finance, behavioral economics. And that is the study of how we as humans are designed to make suboptimal decisions. The way our brain is made, we make suboptimal financial decisions because of our emotional and cognitive biases. And one of those biases is in mental accounting. We tend to focus in on something and kind of put it into a compartment, and then it has to stay in that compartment. And one of the good examples of that when it comes to real estate investing is the heavy focus on cash flow. Now, I shouldn't say that like we never look at cash flow, because each person's situation is different. And sometimes, you know, depending on income and personal needs, cash flow can be more or less important. But cash flow is not what we're analyzing and not what we want to focus on, because remember, we can have a property that does not provide any cash flow, but is still very profitable. And it's very profitable maybe because there's little equity in there, and we're getting the principal reduction, right, from the mortgage payment going down, and we're getting the appreciation, and we're getting the depreciation tax benefits, right? And so our focus again is on the profitability of that property from an after tax. So that's the first component to your question, is we analyze that, and we're comparing that with what other opportunities we have out there, okay? And so we call that opportunity cost, right? We're comparing it with our opportunity costs. Some real estate investors like to use the terminology of required return, right? You've probably heard that one before, but that's a common one in the real estate world to use. Kind of a similar mindset, right? We use opportunity costs to develop that required return. When the profitability starts to drop below that, it's time to make a move, because otherwise we're just going to be seeing decreased returns year in and year out. And then, like you mentioned, say that's a property that, hey, no, this is a good property, it's in a good location, we like it, but the return on equity, the profitability of this property is not very good. So then from that standpoint, right, all right, we can 1031 it if we wanted to change properties, or we pull equity out as we can. It's a tough environment to do a HELOC on investment properties. I've had a number of clients not be successful with that recently. Hopefully those come back, but even just kind of doing rate term refinances. And so a lot of times, like you mentioned, sometimes people have this hesitation of going, oh, geez, I don't want to increase my rate, or I don't want to incur these costs, or, you know, I'm not going to now be cash flowing on this property, right? So there's certain kind of headwinds that we're facing, and it's a case by case basis. But I can tell you people are oftentimes shocked when you run the numbers on the whole wealth and you actually can showcase it doesn't matter sometimes if you pay an extra 1% in interest, because this is allowing you to take this equity and put it to work. Now, we don't want to, right? We want to keep that interest cost as low as possible, but we cannot get too fixated on the cash flow or the interest that we're paying. We instead need to be looking at the impact of our overall wealth, right? How does making this move affect everything else that we have going on 5 years, 10 years, 15 years out? Another good question that came in for me, I don't own any real estate, and I shouldn't, because my best investment is in my business. I don't have time for it. I just told you how much work it takes. I used to own real estate.
Well, you own your own house though.
Yeah, but I'm talking investment real estate. I'm not talking about like, when I talk about real estate, it's investment real estate we're talking about. And the issue is I don't have the time. Because if I were to take the time for it, it's going to take away from my business. And anybody that's seen me, I'm up 4:30 in the morning till 7 working. I've got massive things that I'm building and growing with my business. It makes no sense for me to do it. And to be honest, it'll probably be a while before I get there, but I will. That's fine. The thing about it is the math doesn't lie, right? I'm a math nerd. And that's all I show, is I just show the data, right? Capital gains tax rate is lower this year, right? It is not lower this year. Capital gain tax, depending on your tax bracket, 15% federal or 20%, depending on, if you cross that 20% threshold. Do I see it going back up? Well, it's the same, and it's been the same for a while. When it comes to the capital gain tax rate, I will say there's lots and lots of talk about that going away. The lower capital gain tax rate. Who knows? Who knows if that'll stay? I don't believe really in making decisions based on speculation. I make decisions based on facts and data. So we certainly want to make sure we're prepared in case capital gains taxes go up, but we're not planning for it, if you will. And 5% to state, 100% correct, right? Depending on the state that you're in, 5%. So most of you, depending on where your income is at, is going to fall within that 15% federal, 5% state. Compare that to so that's 20%. Compare that to 29% all the way up to 45%, or excuse me, 42% for ordinary income rates, right? Massive difference. Any other questions that we have? Very good. Thank you so much for your time. I hope this was valuable to give you some different perspective there. And if you've got any questions, by all means, feel free to shoot me an email or something. I'm happy to assist.
Yeah, Matt, will you quickly give everybody your contact info, and if you could type it in the chat box as well?
You bet.
Thank you so much for your time. The part of the reason why I wanted you to speak is because you do have such a different perspective on real estate investing than I know a lot of us are used to or even know about. It certainly took me a while and lots of time meeting with you to kind of wrap my brain around this idea of, like, it's not just the individual investment, it's the investment portfolio overall and what your goals are. And I think that that's a good thing to keep in mind, or at least be aware of, as all of us start investing more in property and building our wealth, and having a good idea of what the end game is. And what in Keller Williams, we talk a lot about the big why, what that is, because depending on what that is, there's a different strategy that might make sense for you. So thank you so much.
Very well put. Thank you, Linda.
Awesome. Thank you.
All right. Thanks so much, Matt.
You bet. Bye.
Take care, everyone.